Welcome, curious minds, to the deep dive. Today we're kicking off with a question that might seem almost too simple, but it holds surprising economic weight. What does the price of wood, of all things, have to do with your economic well-being? We're talking about lumber here, and it's not just, a building material. It's this unexpected, yet actually incredibly powerful bellwether for the broader U.S. economy.
It really is. For decades, the lumber market was, well, it was largely predictable, moved in these well-understood cycles. But if you've been paying attention at all lately, you know it's become anything but predictable.
Yeah.
Think of it less like a gentle river and more like whitewater rafting. You've got rapids, sudden drops.
Definitely feels like that.
We've seen prices surge dramatically post-pandemic, hitting these unbelievable highs, and now it's experiencing a significant downturn. It's been a genuine roller coaster.
A roller coaster is a good way to put it.
And it's definitely not a simple ride back to where we started. It's something new.
That's right. And our mission today is to go way beyond the headlines, beyond those simple ups and downs you might see reported. We want to truly understand what's really happening with lumber prices. We're going to explore why these fluctuations matter so much, what separates, a true market collapse from a really complex correction, and how the ripple effects spread across the housing market, industries, and ultimately right down to your wallet. Our insights today are drawn from a really thorough analysis by Chris Lehnes called Volatile Wood, an analysis of the impact of falling lumber prices on the economy.
Yeah, and our goal for you listening in is basically to provide a shortcut to being genuinely well-informed on this critical economic indicator. We'll connect the dots between something as fundamental as timber, like actual wood,
Right.
and its profound, often kind of unseen impact on your financial landscape. You might just find yourself thinking differently about, well, every piece of wood you encounter after this.
I like that. Okay, let's dive into the fascinating why behind lumber's economic clout. Why is it so much more than just, wood?
Okay, so when you think of economic indicators, your mind probably jumps straight to, the stock market, interest rates, maybe inflation numbers. But lumber, this surprisingly humble commodity, it actually holds a truly unique position among them.
It does.
It's often described as a bellwether for the broader U.S. economy, which sounds kind of important.
It is important, and it isn't just about the simple supply and demand for timber itself. Its price fluctuations are, in fact, a crucial barometer for the health of the residential construction sector.
Ah, okay. The building of houses.
Exactly. And that sector turns out to be a primary, incredibly powerful driver of our gross domestic product, our GDP.
So construction drives the economy, and lumber prices tell us about construction.
That's it. It's like the canary in the coal mine for economic activity tied to homes and building. That's precisely the why behind its outsized significance. You see, wood products, specifically softwood lumber.
The kind used for house frames. Yeah, the structural stuff. It's the foundational material for single-family home construction. So when new homes are being built at a healthy pace, it sets off this whole chain reaction of economic activity.
Like jobs, materials, furnishings, all that stuff.
Right. And this demand for new homes, it's intrinsically linked to broader consumer confidence. People need to feel secure enough in their jobs and their financial futures to make such a huge investment.
Makes sense. Biggest purchase most people ever make.
And it also reflects robust employment levels because construction itself is a major employer. Plus, it's directly impacted by interest rates, which, dictate the cost of getting a mortgage.
Okay, so it connects to confidence, jobs, interest rates, a lot of big economic pieces.
Exactly. So when lumber prices start to move up or down, it can signal shifts in economic activity. Sometimes long before those shifts become apparent in the more conventional data sets economists usually track.
Like the monthly jobs reports or the official GDP figures.
Precisely. Those often come with a lag. Lumber can be more real-time. This makes it a critical, almost predictive metric for market analysts and economists looking for those early warnings, those signs of economic turning points.
What I find particularly insightful here for anyone really trying to track the economy is that point. Changes in lumber prices can signal these shifts before they appear in conventional data. It's almost like an early warning system that's been hiding in plain sight,
That's a great way to put it.
If you want a more holistic understanding of where the economy might be headed, keeping an eye on lumber is surprisingly useful.
Yeah.
The real-time pulse of a massive sector.
It truly is. It allows you to anticipate, maybe see the early tremors before the economic earthquake hits the wider economy, so to speak.
Right.
Imagine being able to spot a change in the housing market's health, maybe months before it's widely reported in government statistics.
That is powerful.
That's the power of the lumber bellwether.
Okay. And speaking of those tremors and the market's roller coaster nature, let's zoom in on how the post-pandemic era just completely scrambled that predictability we mentioned earlier. So for decades, the lumber market had this kind of historical predictability. It wasn't wildly exciting, maybe, but you could almost set your watch by its cycles. Seasonal demand, supply adjustments, pretty steady.
Yeah, it was relatively boring in a good way for economists.
Right. Then along came the COVID-19 pandemic, and suddenly everything just changed, flipped on its head. This period really shifted the market into a state of startling unpredictability. It left analysts scrambling, trying to figure out the new dynamics. Remember those early days? Everyone's stuck at home, staring at their four walls.
Oh, absolutely. The start of the pandemic, combined with those historically low interest rates.
Which were meant to stimulate the economy. Right?
Exactly. Those two things together just ignited this unprecedented surge in demand. People were literally stuck at home realizing, hey, I want to fix this place up.
The DIY boom.
Huge DIY boom. And at the same time, the desire for more space, maybe moving to the suburbs. That drove a massive increase in new home construction. This wasn't just a little bump, it was explosive, almost insatiable demand for wood products.
And what made it even worse on the supply side were those severe pandemic-related disruptions.
Yeah, the supply chains just seized up.
Sawmills, like so many other businesses, faced forced closures, labor shortages, all sorts of operational challenges. It choked their ability to produce.
It was a perfect storm. Surging demand hitting severely constrained supply.
And the result? Prices went, well, ballistic.
Absolutely skyrocketed is the term. At their peak in 2021, prices rose more than 200% above pre-pandemic levels.
200%.
Yeah. To put that in perspective, imagine your grocery bill tripling overnight for basic stuff. That's the kind of shock we saw.
That's a staggering increase. Hard to even wrap your head around.
Indeed. Now, following that period of extreme highs, we've seen what we might call a recalibration, a market correction.
The downswing on the roller coaster.
Pretty much. As rising interest rates started making mortgages much more expensive.
Which they certainly did.
And broader inflation began to sort of temper that housing market frenzy. Well, those sky-high lumber costs inevitably began to decline. It was a natural, if maybe somewhat painful, response to cooling demand and a return to some semblance of supply chain normalcy, though not perfect normalcy by any means.
Okay, but here's where we really need to focus, because this isn't just the market going back to, like, 2019, back to that stable, predictable state.
Oh, definitely not.
What we're witnessing seems far more complex. So if you're thinking, oh, great, it's just going back to normal, that's not quite the picture, is it?
Not at all. Instead, this downturn represents a really complex new phase. It's characterized by persistent volatility, those sharp, rapid swings up and down.
Okay.
But critically, it's happening within a new, higher price baseline than we saw before 2020.
So even though prices dropped from the peak, they're still generally higher than before the pandemic.
Often, yes. Significantly higher sometimes. So while prices have dropped from their absolute peak, they haven't just snapped back to pre-pandemic levels. This isn't back to normal. It's a new normal entirely, one defined by uncertainty, volatility, and generally elevated costs.
That's a really crucial nuance. Understanding that distinction is key to interpreting what happens next, right?
Absolutely. It tells us that the underlying structural changes, maybe increased production costs, lingering supply chain issues, they might mean we don't see those old price levels for a long time, maybe never.
It's a resetting of the whole landscape for lumber.
You got it.
And that idea of a new normal, this volatile baseline, that leads us perfectly into our next section. We need to decode this new reality. Okay, so if you've been following the financial news, you've definitely heard about these big drops in lumber prices. And those headlines can sound pretty alarming, like the whole market is collapsing.
They can, yeah. Lumber prices plummet makes for a dramatic headline.
Right. But as we've started to understand, you really need to look beyond those initial eye-catching figures. A deeper look at the recent data actually shows a more nuanced picture. It challenges that simple narrative of just collapse.
That's a critical point. While headlines often highlight those steep declines, suggesting a full-blown crash, a broader, more comprehensive perspective reveals what we'd call a severe correction, but it's happening within that new elevated price environment we just talked about.
So correction, not collapse.
Exactly. It's not a fundamental collapse.
Yeah.
Let's look at some specifics just to make this clear. As of late August 2025, the framing lumber composite price, that's like an industry average for standard construction wood,
Okay.
it did indeed dip a few percent week over week, month over month. It hit its lowest point for the year. And similarly, lumber futures, which kind of show where traders think prices are heading.
Right, the forward-looking indicator.
Those also dropped significantly, over 10% from the previous month. And these short-term drops, including a really rapid 14% fall from a recent high in early August.
Well, they can understandably make people worry about a market crash if you only look at the immediate data.
Yeah, I can see that. Down 10%, down 14%. That sounds pretty bad in isolation. But here's the critical counterpoint, right? This is what complicates that simple crash narrative. The year-over-year comparison tells a really different story.
A much more robust story, actually.
Despite those recent weekly and monthly declines, the framing lumber composite price was still nearly 6% higher than it was a year ago.
Right, not collapsing compared to last year.
And lumber futures, those forward-looking indicators, were up an even more dramatic 19% year-over-year.
19%, that's significant.
It is. And even the broader producer price index for lumber and wood products, it shows this mix. Recent declines, yes, but also year-over-year increases. It reflects fluctuation, volatility, not just a straight line down, not a free fall. This discrepancy is absolutely vital. It shows pretty clearly that the market isn't just snapping back to its pre-pandemic state.
Which some people might assume.
Right. Nor is it in some catastrophic meltdown. Instead, it's going through this painful recalibration, characterized by sharp, short-term corrections. But these corrections are happening within a persistently volatile but crucially elevated price range.
Okay.
We're not seeing a sustained, fundamental collapse of the industry or demand. What's really defining this new market reality, it isn't the absolute price level itself, although it is generally higher. It's the sheer volatility. The rapid, unpredictable swings, that constant up and down motion, that seems to be the new normal.
It's those sudden, intense fluctuations that are the defining characteristic now.
Yeah.
And that leads us naturally to ask why. Why all this volatility? It feels like, as you said, tectonic plates shifting under the surface, causing all these tremors.
Indeed. This persistent market volatility we're seeing, it isn't down to just one single easy cause. It's really a complex interplay of different forces acting all at once. You've got regulatory policies, environmental factors, and demand-side pressures, and they often interact in unexpected ways.
Okay, let's break those down. Let's start with something that might seem straightforward government policy, but actually has some surprising results. Regulatory influences, especially trade tariffs.
Okay, so a major ongoing factor here is the long-standing trade dispute with Canada over softwood lumber.
Right, this is new. It's been going on for years, hasn't it?
Decades, really. But it continues to significantly impact supply dynamics. It acts like this constant friction point in the market.
And we just saw a fresh development on this. In August 2025, there was another twist.
That's right. The Department of Commerce announced it would more than double its countervailing duties rate on Canadian softwood lumber imports.
Double it. Wow. What were the numbers?
It went from 6.74% up to 14.63%. And when you combine that with existing anti-dumping rates, the total tariffs are now a pretty hefty 35.2%.
35%. That's a huge jump from the previous rate, which was around 14.4%, right?
Exactly. A very substantial increase in the cost of bringing lumber in from Canada.
So the stated intention behind these tariffs,
Mhm.
it's pretty clear, isn't it? To help U.S. sawmills.
Yeah, the explicit intention sounds perfectly logical on paper. Protect U.S. sawmills, make Canadian imports less competitive through these duties, stimulate domestic production, create U.S. jobs. It's a classic protectionist idea.
Give the local guys an advantage.
That's the plan.
Okay, but here's where it gets really interesting. And we see that paradoxical real-world impact you mentioned. Things don't always work out as planned in these complex markets.
Not at all. The anticipation of these higher duties, it actually led to an oversupply problem before the duties even fully kicked in.
How did that happen?
Well, Canadian mills, they saw these higher costs coming, right? So they decided to push large volumes of surplus lumber into the U.S. market ahead of the tariff increase. They wanted to sell it before it got way more expensive to import.
Ah, trying to beat the deadline.
Exactly. But this created a glut, an excess supply, which ironically has driven prices down in the short term.
Wait, so the policy meant to make imports more expensive actually made prices fall?
In the immediate term, yes. It directly counteracted the intended effect. It made domestic lumber face more competition from cheap, pre-tariff Canadian wood, not less.
That's fascinating. A real unintended consequence.
It truly raises important questions about policy effects. The very measure designed to stabilize domestic industry and support prices, it inadvertently contributed to price erosion and market instability.
Wow.
And this rush of oversupply, combined with demand already weakening from the housing market, it put Canadian mills in a really tough spot. Some were reportedly operating below cost just to clear inventory.
So it created this sort of vicious cycle. Oversupply, price drops, then maybe production cuts.
Yeah.
More chaos.
Pretty much. It undermined the policy's goals, at least in the short run, by just adding more volatility.
Incredible how policy can backfire like that. Okay, so that's the regulatory side. What about what's happening on the ground, in the actual sawmills processing the wood?
Well, in response to those, previously high prices that drove up their own costs, and then the subsequent oversupply we just discussed, sawmills in both the U.S. and Canada have been under immense pressure, serious pressure.
So they got squeezed from both ends, high costs, then falling prices for their product.
Exactly. And many have been forced to curtail production, meaning they cut back shifts or operating hours, or in some cases, close down permanently.
That's tough.
It's painful, often devastating for local communities, but from a purely market economics perspective, it's a necessary adjustment sometimes.
The market's self-correcting.
Yeah. It restricts supply, which in the long run helps to stabilize prices and prevent a total free fall when demand is weak.
And have we seen significant impacts, like actual numbers on capacity reduction?
Oh yeah, big numbers. In just a single year, sawmill curtailments across North America reduced softwood lumber capacity by more than 3.1 billion board feet.
3.1 billion board feet.
Billion with a B. That's a truly massive amount of production capacity taken offline.
Well, and beyond these economic pressures, there's always Mother Nature,
Yeah.
right? The wild card.
Absolutely. And an increasingly volatile one, it seems. Environmental factors are a significant and unpredictable risk to timber supply.
You mean things like wildfires?
Especially wildfires, like the intense ones we've seen in the western U.S. and Canada. They can severely disrupt timber harvesting, obviously. They destroy standing forests, they impede transport routes for logs and finished lumber.
Right.
We saw this quite clearly back in June 2023. Remember those massive Canadian wildfires?
Usually, yes.
They temporarily caused lumber costs to climb again, showing how quickly these events can reverse price trends that might otherwise be heading down.
So it just adds another layer of unpredictability, hard to forecast.
Exactly. It makes long-term planning for the industry incredibly difficult.
Okay, so we have trade tariffs causing weird effects, supply being squeezed by mill closures due to economics, and then nature throwing in wildfires. That's a lot on the supply side. What are the other side of the coin? Demand. What's going on with the people who actually buy the wood?
Even with all these complex supply factors swirling around, the single biggest driver of lumber prices, it still remains the housing market.
Makes sense. That's where most of it goes.
Right. And that market, especially for new construction, has been severely constrained. Two big reasons.
Let me guess. Interest rates.
That's number one. Persistently high interest rates make borrowing expensive. And number two, broader economic uncertainty. It makes consumers hesitant about making huge purchases, like a house.
Yeah, that rings true for anyone thinking about buying a home right now. High mortgage rates are really keeping a lot of potential buyers on the sidelines, aren't they?
Definitely. The cost of financing a home, even if the sticker price looks okay, the monthly payment can become just too high for many budgets.
So you see weaker buyer traffic at open houses, fewer sales happening.
Exactly. Even if someone wants to buy, the numbers just don't work for a big chunk of the population right now.
And the data backs this up.
It does. Now, total housing starts in June 2025 showed a little upward momentum overall.
Oh, okay. So some good news.
Well, yes and no. That increase was largely driven by a big jump, 30% in multifamily starts.
Apartment buildings, condos.
Right. And while those are important for housing supply, they typically use far less softwood lumber per unit compared to a single-family house.
Okay, so not as much wood needed for apartments. What about single-family homes?
That's the key for lumber. Single-family housing starts the primary driver of softwood lumber consumption. They actually fell 4.6%.
It fell. Okay.
Yeah, fell to their lowest level in nearly a year. So multifamily construction isn't picking up the slack for lumber demand.
Got it. And what about renovations, the DIY stuff?
That's down too. The home renovation and repair market, another important area for lumber, saw roughly a 7% drop in 2024 compared to the year before. So that further curbs overall demand. Less new single-family building, fewer big renovation projects. It means significantly less demand for wood across the board.
Okay, that paints a really clear picture of all these powerful shifting forces: policy, nature, economics, consumer behavior. Now let's connect all this back to you, the listener, the consumer. What do these falling lumber prices actually mean for the housing market and the cost of buying a new home? So the big question, lumber prices are falling. Does that mean new homes are suddenly getting much cheaper? It feels like a logical leap, doesn't it? Wood is cheaper? How should it be cheaper?
It's a natural assumption, but to really get it, we need to unpack the whole cost structure of a new home. Lumber is definitely a crucial piece, no doubt, but it's far from the only piece.
Right. It's like looking at a car's price and only thinking about the cost of the tires.
That's a good analogy. It's an important part, but just one part. And this is where the nuance really matters. According to the National Association of Home Builders 2024 Construction Cost Survey, construction costs actually made up a huge chunk, around 64.4% of the average new home sales price.
64%. So almost two-thirds of the price is just building the thing?
Pretty much. And that average price they looked at was around $665,298.
Okay, so over $400,000 of that is construction cost.
Right.
And within those construction costs, where does lumber fit in? The framing part.
Exactly. The framing category, that's your roof framing, trusses, sheathing, all the structural wood. That was the single largest expense category within construction, representing 16.6% of the total construction costs.
16.6%. Okay, so on that average $665,000 home, how is that in dollars?
That works out to about $70,982 just for the framing.
$70,000. Okay, that's definitely a significant chunk of change. Lumber costs are clearly meaningful for a builder.
They absolutely are. And framing did see the biggest percentage point drop between 2022 and 2024. It fell from 20.5% down to that 16.6% of construction costs. So cheaper lumber did make a difference there.
Okay, that's good news for builders.
It is. But a huge portion of a new home's cost is made up of other things, other materials, labor, services.
Right. What else is a big chunk?
Well, you've got foundations, concrete, maybe some block work. That's about 10.5% of construction cost. Major systems, rough-ins, think plumbing, HVAC, electrical wiring. That's another 19.2%. And then interior finishes, cabinets, flooring, paint, fixtures. That's usually the single biggest category within construction, around 24.1%.
24% just for finishes. Wow.
Yeah. And the crucial point here is that many of these other cost categories, especially skilled labor, land, specialized finishes, they haven't seen the same kind of price drop as lumber. Their costs often remain elevated or are still rising.
Okay. So this is where the picture gets complicated for the average home buyer hoping for a deal. It shows that a drop in lumber prices, while it's meaningful for the builder's bottom line, it doesn't automatically mean a proportional or even a really noticeable drop in the final sales price of the home.
Exactly. And we haven't even mentioned the costs outside of direct construction yet.
Like what?
Well, land costs are huge, often around 13.7% of the total sales price. That finished lot doesn't come cheap.
Right. Location, location, location.
Then you have substantial labor costs, maybe 25% of the total construction costs, which generally don't fluctuate much with material prices. Good labor is still expensive.
Okay.
And of course, the builder needs to cover overhead, marketing, financing costs, and make a profit margin. That all gets factored into the final price tag, too.
So if we go back to that $665,000 average home.
Yeah, let's break it down roughly. You've got that $71,000 for framing, but you also have maybe $103,000 for interior finishes.
Wow.
Maybe $91,000 just for the finished lot costs.
91 grand for the land.
And then another $145,000 or more covering financing, overhead, marketing, sales commissions, and the builder's profit.
Okay, so when you put it like that.
Right. Even if the cost of lumber within that $70,000 framing portion drops significantly, say 20%.
That's about a $14,000 saving.
Exactly. A $14,000 saving on a nearly $700,000 home. It helps, but it only moves the needle so much when you have all these other huge and often still high costs.
The total cost is just a much more complex equation than just the price of wood.
Absolutely.
That really paints a much clearer picture. Explains why your dream home might not suddenly be drastically cheaper just because 2x4s are on sale. And speaking of dreams versus reality, there seems to be this real disconnect between what builders are feeling and what consumers can actually afford right now.
Okay, so you'd think maybe lower lumber prices, giving builders a bit of a break on costs, that might create a more favorable environment for construction, give them a bit of a boost.
You'd logically think so, yeah. A little cost relief should help. But what we're actually seeing is this significant and kind of stubborn disconnect. The cost relief isn't translating into a big surge of activity or optimism.
That's right, home builder confidence. Despite any lumber price drops they might be enjoying, it's actually been in negative territory for, get this, 16 consecutive months as of August 2025.
16 months in negative territory. That's grim.
It is. And this persistent pessimism, it isn't primarily about the cost of lumber anymore. It's driven overwhelmingly by those stubbornly high mortgage rates and persistently weak buyer traffic.
Ah, back to the interest rates and lack of buyers.
Those remain the towering obstacles. Builders just aren't seeing enough buyers walking through the door, even if they have some cost savings they could potentially pass on.
So builders are clearly feeling the pinch from weak demand. What are they actually doing about it? Are they just sitting tight?
Oh no, they're trying everything. Every tool in the toolbox to try and stimulate sales in this tough environment. Many builders are actively cutting their asking prices. The data shows almost a third of builders reduced home prices back in June 2024 to try and get deals done.
A third of them cutting prices. That's significant.
It is. And they're also offering incentives. Things like covering closing costs, offering free upgrades in the design center, or even buying down the mortgage rate for the buyer for the first couple of years.
Trying to make the monthly payment more palatable.
Exactly. It's a clear sign of their struggle to move inventory when consumers are so hesitant.
But even with builders cutting prices and offering deals and the lower lumber costs, demand is still weak.
Stubbornly weak, yeah. Potential buyers are just held back by those high borrowing costs.
So the lower price of wood isn't enough. It can't overcome the fundamental hurdle of an expensive mortgage and a high monthly payment. The math just doesn't add up for many families.
Precisely. The underlying challenge for the housing market, and therefore for lumber demand, is fundamental affordability.
It's not just the house price. It's the total cost of ownership.
Right. And while lumber cost has dropped, other critical construction costs. Skilled labor is still expensive and hard to find. Land prices are high. Non-wood materials like concrete, steel, drywall, they remain elevated or are still climbing.
So a drop in just one component, even a big one like lumber, it's just not enough to make homeownership widely accessible again for people struggling with the overall cost of living.
Sadly, no. So the market is very much in this wait-and-see mode.
Waiting for
Mortgage rates to come down, basically. Industry experts widely believe that a significant recovery in housing demand will only happen when mortgage rates fall to a critical threshold.
Is there a specific number people talk about?
The range often mentioned is somewhere between 5.5% and 6% for a 30-year fixed mortgage.
Okay, so down from the current highs.
Significantly down. Experts think hitting that range is necessary to really unlock significant housing demand and stimulate a true recovery. Until then, builders are going to keep grappling with this fragile market. They can't fully capitalize on lower material costs because the demand just isn't there at current borrowing rates.
That's a really stark reality check for anyone hoping for a quick housing market rebound. It all comes back to interest rates. And even when those material prices do drop, there's another crucial factor affecting how quickly you, the consumer, might feel any benefit. You called it the lag effect earlier.
Yes, the lag effect. This is a really crucial and often overlooked aspect of the lumber market and markets in general. It's a key concept. Price transmission asymmetry.
Okay, price transmission asymmetry. Let's unpack that. Sounds complicated, but what does it actually mean for us?
In simple terms, it just means that prices move in different directions at different speeds. It's not symmetrical.
Okay, how so?
Think of it this way. When market prices for lumber are increasing, those higher costs get passed on down the chain to builders and ultimately to consumers with remarkable speed, almost instantly sometimes.
Why so fast?
Well, the wholesalers and retailers in a rising market, they're kind of trigger happy. They quickly update their price quotes to reflect the current higher market rates. They want to protect their profit margins and, frankly, capitalize on that upward momentum.
So you, the buyer, feel the pain of rising prices almost immediately.
Pretty much, yeah.
Okay, so when prices go up, everyone's quick to pass on the higher costs. Makes sense. But what about when prices are falling, like they have been recently? Is it the same speed in reverse? Does the relief come just as quickly?
And here's the asymmetry part. No. Conversely, when prices are falling, there is a significant lag before that price relief actually reaches the builder and then eventually the consumer.
A lag. How long are we talking?
Research suggests it can take at least a few weeks, maybe even a couple of months.
Weeks or months. Why the delay? Are suppliers just trying to hold on to higher profits?
It's not necessarily that, although that could be a small factor. The main reason is they have to work through their existing high-cost inventory first.
Ah, they bought the wood when prices were high.
Exactly. They purchased that lumber during the period of higher prices, and they need to sell that off before they can start selling new inventory at the new lower market price and still make their margin.
Okay, that makes sense. They can't sell below what they paid for it.
Right. And the size and buying power of the builder and the supplier also play a role.
How so?
Larger builders, the big national ones with more leverage and buying power, they might see those lower prices reflected sooner than smaller, independent contractors. They can negotiate better or have different contracts.
Okay, so this asymmetry, this lag, it has a real tangible impact, doesn't it, on consumers, on the economy?
It really does. It means the pain of inflation is felt almost immediately. As soon as prices start climbing, you feel it. But the benefits of falling prices, they're significantly delayed. And that dampens the positive economic effect of the price drop for those who might otherwise benefit.
It's a frustrating reality for anyone hoping for a quick break on costs. It makes any economic recovery feel slower, more sluggish than the initial downturn felt.
Absolutely. It highlights why the overall economic recovery can feel so uneven, even when some indicators, like lumber prices, seem to be moving in a positive direction. That lag effect is a substantial friction point. It's like a drag on any potential feel-good factor from falling material costs.
Okay, so we've talked a lot about the immediate impact on home prices and affordability. But the ripple effect of these volatile lumber prices, it extends way beyond just the cost of a new house, right? Let's dive into what's happening upstream and downstream in the economy. Falling lumber prices. It might sound like purely good news for consumers or builders, maybe, but there are some very real and often quite painful economic consequences that spread through the economy, especially for the businesses and workers right at the beginning of the supply chain.
Yeah, the decline in lumber prices has had a profound and, frankly, painful impact on the upstream sectors. We're talking about the forestry and sawmill industries.
The companies harvesting the trees in the mills, turning logs into lumber.
Exactly. They are right at the sharp end of any market downturn like this. They feel it first and often hardest.
And this isn't the first time we've seen this kind of pain in that sector, is it? History has some stark lessons here.
No, it's definitely not the first time. During the 2008 financial crisis, for example, the value of wood and paper products out west just plummeted. It led to massive job losses, tens of thousands, and lumber production cuts of nearly 50% in that industry.
50%.
Devastating.
Utterly devastating for communities that relied heavily on timber. It was a painful reminder of how vulnerable this sector can be to these cycles.
And even before that, like the 80s recession.
Similar story, yeah. Maybe slightly less extreme overall, but still bad. Lumber prices fell sharply, over 48% in 3 years. It caused widespread mill closures and really high unemployment, over 25% in some timber towns. These historical echoes really underscore the structural vulnerability of these industries.
And are we seeing similar trends today? Maybe not as severe as 2008, but still. We are indeed seeing similar trends, yes, albeit within that new, more volatile but higher baseline price environment we discussed. The number of businesses establishments in wood product manufacturing and logging combined, it's dropped by a significant 8,700 over the past 5 years alone.
8,700 businesses gone.
Yeah. And projections show a further contraction of another 6% through 2027. The logging industry specifically is projected to see a 7% decline in employment just in the next 5 years.
That's a lot of job losses. And it really hits those communities hard, doesn't it? Entire towns can be built around a single mill or logging operation.
Absolutely. The impact is very localized and very deep.
And for the sawmills themselves, the ones still operating, what's the situation for them right now?
It's particularly difficult, with market prices falling below their actual cost of production in many cases.
They're losing money on every piece of wood they sell.
Potentially, yeah, or making very little. So they're forced into tough decisions, either curtail output, cut back shifts, reduce operating hours, or, unfortunately, close down permanently.
We saw data on that earlier, right? The utilization rate was low.
Very low. The utilization rate for U.S. sawmills and wood preservation firms was just 64.4% in the first quarter of 2025. That's a lot of unused capacity, a clear sign of underproduction.
And employment is falling too.
Yes, employment in the industry fell for 3 consecutive quarters. It's currently around 88,500 workers. Now, these closures, they are undeniably painful for everyone affected, the workers, the communities, but as we said, they are a critical, albeit harsh, part of the market cycle. They restrict supply.
Which eventually helps stabilize prices.
Right. It helps rebalance supply and demand, setting the stage for a potential future rebound, assuming demand returns.
A painful, necessary evil from a pure market perspective, as you put it earlier. And the data shows the scale. A 75% drop from the 2021 peak price resulted in over 3.1 billion board feet of North American capacity being cut. The pain is very real at the source.
Very real.
Okay, so that's the upstream pain. But what about downstream? The retailers, the manufacturers who buy the lumber, are they all thriving now with cheaper wood?
Well, the effects of falling lumber prices, they do extend beyond the lumberyard itself, but it creates more of a mixed bag of outcomes downstream. It's not a simple, uniform benefit for everyone who uses or sells wood products.
Can you give us some examples? Like, how are the big home improvement stores or major suppliers doing in this environment?
Sure. Major players have seen varied results, really reflecting those broader economic headwinds we keep coming back to. Home Depot, for instance, reported a 3.2% drop in their U.S. sales recently.
Got to see as we're down.
Yeah, and they linked that decline not primarily to the cost of lumber, but to weakened construction and renovation demand because of high borrowing costs. People just weren't doing as many big projects.
So cheaper wood didn't boost their sales enough to offset the impact of high interest rates.
Exactly. Similarly, Builders FirstSource, they're one of the biggest suppliers of building materials to the construction industry.
Right.
They also reported a year-over-year fall in their second quarter net sales and income.
So what does this tell us? For you, the listener, and for these big businesses, it sounds like the benefits of lower lumber costs just aren't enough to overcome the bigger economic challenges.
That's precisely it. The benefit of lower lumber cost, while helpful for a builder's input expense line, it's just not proving sufficient to overcome the broader macroeconomic headwinds. The high interest rates, the stagnant housing market,
Oh.
those are the dominant forces right now.
So the core problem for these retailers isn't really the price of lumber itself.
No, it's more about the reduced activity among their core customers. Both the DIY consumers and the professional builders are pulling back on large projects because financing is tight and economic uncertainty is high.
So their success depends less on lumber prices and more on things like focusing on their pro-contractor customers, managing inventory well, being agile.
Exactly. Operational efficiency, strong customer relationships, adapting quickly, those become key in navigating these difficult waters. It's less about the input cost of one commodity.
It's a good reminder that the economy is this incredibly complex web. So many variables are in play all at once. Lumber's important, yes, but it's not the only factor by a long shot. Which brings us to a really critical point about lumber's ultimate role in the bigger economic picture.
Right. While lumber prices are definitely an important piece of the economic puzzle and a valuable forward-looking indicator, as we discussed, their direct effect on broader inflation metrics, like the main consumer price index, CPI, that gets reported, it's actually more indirect.
Okay, how so? Doesn't cheaper wood mean cheaper stuff eventually?
Well, yes, but the producer price index, the PPI for lumber and wood products, is useful for tracking those specific business input costs. But its impact on the final demand PPI, the prices businesses ultimately charge, gets moderated. It's diluted by the costs of countless other goods, services, energy, everything else that goes into the final price.
So it's one ingredient among many in the overall inflation soup.
A good way to put it. It's one piece of a much larger, intricate puzzle that makes up overall inflation. It doesn't drive the whole index by itself.
Okay, so if lumber isn't directly driving broader inflation that much, what is it reflecting about the economy? Is it causing downturns or reacting to them?
The research strongly suggests it's more of a reactor. Factors like overall housing prices, industrial output levels, general economic uncertainty, those are the things that seem to significantly influence these abrupt movements in lumber prices.
So lumber prices move because of those bigger factors.
Largely, yes. It indicates that lumber is more a reflection of broader economic health and confidence than it is a primary driver of it.
So think of it like a sensitive barometer for the economy's vital signs, rather than the engine pushing the whole system forward.
Exactly. Its volatility is more of a response to, rather than the instigator of, these wider economic shifts.
And we have pretty compelling historical proof of this, don't we? That lumber often signals a problem rather than causes it.
We absolutely do. Think back to those past economic crises we mentioned. The recession in the early 1980s, that dramatic lumber price drop, over 48%, it was a direct consequence of soaring interest rates and a housing market collapse that were already happening.
Lumber prices fell because the economy tanked.
Right. And the 2008 financial crisis, Similar story. Plummeting lumber prices, production cuts, massive job losses. In both cases, the collapse of lumber prices was a profound symptom of a much larger economic downturn. It clearly demonstrated its role as a leading indicator of economic pain rather than the root cause of the crisis.
So the current situation, with the job losses in forestry, the production cuts, falling builder confidence, it serves as another stark reminder of these historical precedents.
It really does. It reveals that structural vulnerability of specific regions and sectors to this cyclical volatility. It's an early warning sign that something bigger is going on with consumer confidence, borrowing costs, and overall economic momentum.
This all makes perfect sense. It reinforces that idea of lumber as a crucial indicator, a pulse check on the economy's health. So with all these complex forces and ripple effects, who ultimately benefits and who really suffers when lumber prices take a dive like they have recently? Hashtag V. Winners, losers, and nuanced outcomes of lumber.
Okay, so given everything we've talked about, it's pretty clear there aren't just simple winners and losers when lumber prices swing around like this. It seems much more nuanced.
It definitely is. It's not black and white.
But certain segments definitely seem to come out ahead, at least relatively, while others really bear the brunt of the downturn. Let's start with potential beneficiaries. Hashtag VA, the beneficiaries of a lumber price downturn.
In the current market environment, the primary beneficiaries of falling lumber prices are probably certain segments of the construction industry, and maybe to a more limited and indirect extent, some consumers.
Okay, let's focus on construction first. Home builders, contractors, how do they benefit? Well, they're now able to secure lumber for future projects at lower costs than they might have just a few months ago, and that can be a real advantage for them. It helps offset some of the financial incentives they're currently offering to buyers.
Like those price cuts and rate buydowns we talked about.
Exactly. Offering those incentives costs the builder money. Lower lumber costs help absorb some of that hit, protecting their margins somewhat, while still trying to stimulate sales in this tough market.
So it's a bit of a cost saving that helps them sweeten the deal for potential buyers, basically reducing their own input costs on a really crucial material.
That's a good way to summarize it.
Does scale matter here? Like, does a big national builder benefit more or faster than a small local contractor?
Scale definitely matters. Builders of all sizes can benefit eventually, but the larger residential construction firms, the ones with greater buying power, maybe established long-term supplier relationships, they often see that price relief sooner and more effectively.
How is that?
They just have more leverage to negotiate better deals. They might get updated pricing faster from suppliers, or they can buy in larger volumes when prices look favorable, locking in savings.
Whereas a smaller local contractor might still be working through inventory they bought at higher costs, or just doesn't have the same negotiating power.
That's generally how it works, yeah.
Okay. Now, what about the individual consumer? You said the benefits are more limited and indirect. Are we seeing lower home prices because wood is cheaper?
Generally, the benefits for the consumer are more delayed and partial. We touched on this with the lag effect, remember?
Right, the asymmetry.
Exactly. While a drop in lumber costs does reduce one component of a new home's price, that reduction is often just insufficient to overcome the main barrier for most potential buyers.
Which is still high mortgage rates.
Still high mortgage rates. Furthermore, the full benefit of lower material costs often gets absorbed, at least partially, by the builders and suppliers themselves.
To protect their own profit margins.
Yeah, exactly. Their margins have been squeezed by rising overhead, land costs, labor expenses, all those other things we discussed. They need to recover some of those costs before they pass on the full savings from just one input like lumber.
Okay, so who are the consumers who might actually come out on top in this situation, if it's not a broad benefit for everyone?
The most likely winners among consumers are probably those who are already in a strong financial position.
Meaning?
Meaning maybe they have substantial savings for a large down payment, maybe they're able to secure more favorable financing with a lower interest rate despite the overall environment, or perhaps they're less reliant on a mortgage altogether, maybe paying cash.
Ah, okay. People who aren't as sensitive to the high interest rates.
Exactly. These are the individuals who can therefore take advantage of the current market's incentives and the lower material costs. They have the financial resilience to navigate the high-rate environment and are well-positioned to benefit from any material cost reductions without feeling that financing pinch quite so badly.
That makes perfect sense. It's not a broad tide lifting all boats, but more of a targeted benefit for those already in a good spot financially. Okay, conversely, where is the pain most concentrated when lumber prices fall? Who gets left vulnerable? hashtag tag tag VB, those left vulnerable by lumber prices.
The negative impacts of this lumber price correction, they are heavily concentrated upstream, in those sectors right at the beginning of the supply chain.
The forestry and processing industries again?
Exactly. The industries directly involved in harvesting the timber and the initial processing, they are the most exposed to price drops and demand fluctuations.
We're talking specifically about sawmills, right? The places turning logs into usable wood.
Yes, sawmills are particularly vulnerable, especially smaller ones, or those with less operational flexibility, maybe older equipment or high debt loads. They're suffering significantly as prices fall below their cost of production. It just becomes unsustainable to operate at full capacity, or sometimes even at all.
So that leads to those curtailments or closures we discussed earlier.
Exactly. Forced curtailments, reducing hours or shifts, maybe temporary shutdowns, and unfortunately permanent closures too. This directly results in that reduction in domestic production capacity we mentioned and a clear decline in employment within the industry. It hits a vital part of the manufacturing sector hard.
And the loggers, the crews who actually supply the raw timber to these mills, they must be feeling the pinch too.
Absolutely. It's a domino effect. Upstream logging operations are also negatively affected. With reduced demand from the sawmills that buy their logs and lower prices being offered for that timber, they face significant revenue declines.
So less work, less income.
Right. It leads to reduced activity out in the forests, job losses for logging crews, equipment sitting idle, just an overall economic contraction within that specific sector. Their fortunes are directly tied to the health of the sawmills they supply.
And is this pain felt uniformly across the country? Or are some areas hit much harder than others?
Oh, it's definitely not distributed uniformly. The pain is disproportionately felt in those regional economies that are heavily reliant on the forestry sector.
Timber towns.
Exactly.
Right.
Often rural communities where logging and sawmills are the major, sometimes the only, major employers. These communities face the real specter of widespread job losses, local business failures, significant economic hardship. It truly exposes a kind of structural fragility within parts of the U.S. economy that only really becomes apparent during these periods of commodity price volatility.
Yeah, and the delayed price relief for them, plus the ongoing uncertainty.
Yeah.
It must create a really difficult environment for businesses and workers in that industry. Hard to plan, hard to invest.
Incredibly difficult. It makes it hard to retain skilled labor, hard to make long-term decisions, just a very unpredictable and stressful environment.
It's a really stark reminder of how interconnected everything is. A price change for lumber, something traded on exchanges far away, can have such profound, localized impacts on real people and communities. So with all that context, what does this all mean for the future? How do experts see this volatile situation evolving from here? All right, looking ahead. Forecasting the future of the lumber market is clearly not easy, not with all these moving parts.
No, definitely not crystal ball territory here. There's a high degree of uncertainty reflecting all those complex forces we've been discussing.
But experts do have some projections, right?
Yeah.
Even if they come with plenty of caveats.
That's right. Generally, experts anticipate that prices will likely remain within a volatile range, but probably stabilize within a band. Maybe somewhere between $500 and $600 per thousand board feet for the rest of 2025.
Okay, $500 to $600. So still bouncing around, but maybe not plummeting further.
That seems to be the consensus. It suggests that while we'll continue to see those sharp, short-term corrections, the daily and weekly ups and downs, the overall trend isn't a continued freefall. It's more like a choppy sideways movement, but within that defined, still somewhat elevated range.
Got it. A bit more stability in the overall range, but still plenty of those rapid swings within it. Are there any projections for prices eventually moving higher again from these current levels?
Yes, some projections do anticipate a slight gradual rise in lumber futures down the road. Some estimates put them around $627 per thousand board feet in the third quarter of 2025, maybe increasing towards $673 or so over the next 12 months.
Okay, so a cautious, gradual upward trend might be expected by some.
That seems to be the thinking. And looking longer term, the general consensus suggests prices probably will eventually move higher again.
Why? What's the reasoning there?
It comes down to those persistent underlying supply constraints we talked about.
Like the mill closures reducing capacity.
Exactly. That roughly 7% reduction in U.S. production capacity from mill closures isn't coming back quickly. Plus, the ongoing disruption of Canadian imports due to tariffs, those fundamental supply issues aren't just going away.
So as demand eventually picks back up, those supply limits will push prices up.
That's the theory. Limited supply facing recovering demand usually means higher prices.
Okay, but here's the game changer, right? The big if. The ultimate factor that seems to dictate everything else in this market.
Exactly. It's all dependent on that singular external force, the Federal Reserve's monetary policy.
Interest rates again.
Interest rates again. Specifically, their decisions on cutting interest rates. The housing and construction markets have basically been in this prolonged wait-and-see phase. Industry observers are openly hoping for a rate cut.
Everyone from loggers to builders is just watching the Fed.
Pretty much. They understand that Fed policy dictates the cost of money, and the cost of money is the absolute lifeblood of the housing market. Everything hinges on it.
So what's that critical mortgage rate threshold again? The one experts think would really unlock housing demand and change the whole outlook for lumber.
They believe a substantial drop in the 30-year fixed mortgage rate is needed, down to that critical threshold, likely somewhere in the range of 5.5% to 6%.
5.5% to 6%.
Getting rates down into that zone is seen as absolutely necessary to really unlock significant housing demand and stimulate a true recovery in new home sales and construction.
And without that, without the Fed cutting rates significantly,
Then a major rebound in housing starts, and therefore a subsequent surge in lumber demand. It's just considered unlikely. Regardless of the supply-side issues, high interest rates remain the fundamental bottleneck. They make homes unaffordable for too many people.
it's just crystal clear.
Yeah.
Policy decisions from the Fed are going to steer this ship more than almost any other single factor. Okay, so given all this uncertainty, these complex dynamics, the huge dependence on the Fed, what strategic recommendations emerge for businesses involved in the market and for policymakers looking at the bigger picture? #tag VIB, strategic recommendations for market participants and policymakers.
Well, for home builders and contractors on the ground, it seems advisable to maybe take advantage of the current lower, albeit volatile pricing, secure lumber for future projects now, especially if they anticipate an eventual rebound in demand and a corresponding rise in prices later.
Lock in lower rates while they can. A risk management move.
Could be a smart play, yeah. Hedging against future price increases. And additionally, to mitigate those supply chain risks and just build more resilience, they should really consider diversifying their material sources.
Not relying on just one supplier or region.
Exactly. And building strong, reliable relationships with local suppliers can be really beneficial too.
Why local?
It can help reduce transportation costs, enhance reliability, maybe less chance of disruption, and just provide more flexibility, especially in an unpredictable market where long, complex supply chains can break down.
Okay, those sound like practical, proactive steps businesses can take themselves. What about for policymakers, the ones looking at the national economy, industry health? What could they do?
From a policy perspective, one big thing stands out. Finding a long-term resolution to that contentious U.S.-Canada softwood lumber dispute, it's absolutely critical.
That tariff fight needs a permanent solution.
Desperately. This disagreement has dragged on for decades, creating persistent uncertainty and adding significant costs for everyone involved. And experts point out that other potential trade partners, maybe places like Germany or Sweden, they simply don't have the capacity to fill the huge void if Canadian imports were significantly reduced long-term.
Canada provides a lot of our lumber, right?
Nearly a quarter of the U.S. softwood lumber supply, traditionally. So negotiating a stable, long-term agreement that effectively reduces or eliminates these tariffs, it's really essential.
For ensuring a stable, predictable, and cost-effective supply of lumber into the U.S. market.
Exactly. That would benefit both producers who use the lumber and consumers who buy the final products.
Okay, so fixing the trade dispute with Canada is key for supply. Anything else on the domestic front policymakers could focus on?
Yes, there also seems to be a clear need for more strategic investment right here in the domestic forestry supply chain.
Investing in U.S. logging and mills.
Pretty much. That could include supporting technological advancements in U.S. sawmills, making them more efficient, more automated, more resilient, better able to compete globally. It could also mean encouraging the adoption of precision forestry techniques, using technology for more sustainable and efficient harvesting out in the forests.
So boosting domestic efficiency and production capacity.
Right. These measures could ultimately help the U.S. better meet its own demand for lumber in the long run, reducing our reliance on volatile international sources and strengthening a really vital domestic industry at the same time.
Okay, that brings us toward the end of our deep dive into the surprisingly complex and volatile world of lumber. #tag outro. So just to recap our journey today, we've seen that lumber, it's this surprisingly powerful, though definitely complex economic leading indicator, the current price drop. It's not a full-blown market collapse. It's more like a severe correction happening within a new, highly volatile market reality.
Right. And we also unpacked that crucial asymmetry in price transmission. The way the pain of inflation hits fast, but the benefits of falling prices. They're frustratingly delayed.
Yeah, that lag effect is key.
And the bottom line here seems to be that while some financially strong players, maybe larger builders, might manage to capitalize on lower material costs, the really profound impact of this downturn is felt primarily by those upstream sectors, the loggers, the sawmills facing job losses and closures.
And the true engine that will drive everything forward.
It remains the housing market, which itself is fundamentally tied to what the Federal Reserve decides to do with interest rates. It's all connected in this intricate web.
It really is. This deep dive truly reveals how incredibly interconnected our economy is. How a seemingly mundane commodity like lumber can tell such a huge story.
Commercial bakeries can benefit from the additional working capital factoring can provide. Contact Chris Lehnes at Versant Funding to learn if your client is a factoring fit.
Contact Chris Lehnes of Versant Funding to learn if factoring can provide your business the cash you need to expand.